Good morning, everybody. This is live trading talk with Patrick MontesDeOca. We got some fast markets right now in precious metals here. We are taking a position in silver. So we're going to be buying a silver at the market here right at the opening.
Order filled.
Long one silver. Now, I'm going to get into the signal here a little more deeply, and we're going to focus on trading. We got some volatility in the market here today, and it's a perfect day as we look for these trades. Basically, these are the kinds of trades that we look for. So we're looking at silver at the blue line here that you see here, which is the buy one level that tells you this is a pivot point. This is a support level. And the VCPMI basically transforms this into a probability model that tells us that when the price comes down to this level here, we're looking and activating about a 90% probability that upon the market coming down here, identifying the buying, the buying strength of the supply and demand, that more than likely we're going to get a reversion. And what you see here is the market came down to a low of 2262, and the buy one level was 2260. Within a margin of error of 10%, we bought this market because the pattern appears to be completed. And what you see here, there's little cycles, there's little other 30-day cycles that we watch, in addition to several other metrics that we use that we basically put over the codes or the variable changing price momentum indicator to identify the relationship of basically price, time, and in the markets relationships. What we see here today is a strong market in gold, and we don't want to get into any fundamentals, the reason why or why not, or I want to focus right now on just trading technically the market using the VCPMI. I'm been looking for this opportunity. So we got the gold market here on an average of 1786, which is a standard deviation 50-50 that tells us that the price can chop around here, and which is why I say don't trade around the average price. You're going to get chopped up, and you got to be prepared to put a stop reverse signal, and you be getting yourself stopped out, in and out, and I'd rather not do that. I look for the highest probability trades, and that is essentially when this algorithm identifies it for me, and I can make a decision based upon my own profile. So I use this as a metrics to know the extreme levels of where the market is in relation to its average price, and the extremes above that average price or the extremes below that average price. The whole structure of my trading is basically creating a very specific structure. I use 5 Fibonacci levels of pivot points, no more than that. And we convert those pivot points basically to a mathematical algorithm, an algo that tells us probabilities within very specific ranges of a maximum standard deviation to its mean. And so when we get around the average price, it's about a 50-50 standard deviation. When the price reaches the sell one or sell two levels, it's about a 90 to 95% probability that if we do get activated, the reversion to the mean will unfold. Where we are right now, and I'm talking about the gold market, but I want to identify for you the relationship of the gold market in terms of its own criteria and where it is and in relation to where silver is, so that we can measure whether one is overbought or oversold to the other, and then you can go on and make a decision as to whether you want to buy whatever instrument you want to buy, the gold silver spread, or options, futures, stocks. That depends upon your profile. Now, identifying that the gold market is bullish, price momentum using the daily signals, and also the target of 1801 is activated as a consequence of this momentum. It has identified the daily momentum of the market. So if you hold in long positions, it's pretty much telling you to hold on to it and look for the target of 1801. Now, we did not come down to the weekly but we did make a low of 1771 on the 30th. And it did not quite come down to the weekly numbers. This would have been an ideal harmonic place to buy. You see the relationship of price between the two trends is pretty close. So the gold market is trading between the daily and the weekly average. The daily has a target of 1801 to 1827. That's pretty much where we are right now with gold. And if we take a look at the silver closely, we've come down, making a low of 2262, and the daily signal today was telling us to buy at 2260. Right underneath there, we have a tremendous harmonic relationship between the daily 2333 and the weekly 2238. So I am prepared to load up the truck if we had a chance to come down here. Now, in terms of the short-term trades that we're doing here for the day, using the 15-minute bar, we bought the market here simply because I'm using about a 10% margin of error with a low of 62 and the algorithm 60. That's close enough. So we bought the gold market. Now, the silver market, excuse me. Now, the silver market here is oversold to the gold market. As you can see here, it's trading below the daily average. And it's trading below the weekly average. Right into a buy-in area that is pretty close to daily and weekly harmonically. The AI tells you to buy, this is the area. The algorithm lights up in blue when the price is at the extreme below the average, below the mean. And what we do is we basically mean reversion trade the extremes above and below the market. For day trading, we have a very specific structure, and also for weekly or monthly or for long-term trading, it also gives you a very specific structure And again, it uses standard deviation, WD-GAN formulas, Fibonacci structures. It's a combination of different, very complex indicators. And what I'm doing here is I'm simply reverse engineering the algorithm that, and I'm showing you how I'm using it, and in combination to conventional indicators, for example, like Bollinger Bands. And you can see that even the Bollinger Band here came down into an extreme level below. And the Bollinger Band pretty much give you standard deviation that between the ranges, it's an extreme probability. Above the Bollinger Band, the upper band, you're looking at a usually 95% probability. So it's another probability model that looks for basically the extremes of the market. As long as I've been trading here, what I have found basically is that the market has a built-in metrics that is called reversion to the mean, regardless of where the price goes. And there will be an equilibrium in price throughout the trend of that particular market. But what you'll see is that in times of speculation, the price will go to an extreme. Above the mean, so the probabilities are that it got overbought. That's what most technical analysts call overbought. But the algorithm identifies the specific price and the action, what to take. It's not just a number. And so what I'm teaching my traders in my private trading group throughout the day, and what I'm doing here for the first half hour, is giving you the courtesy to see how to trade this live. And pretty much, it's a real-time metrics that you can use as a GPS to guide your trading. And so understanding that the price of gold is a bit over, or I would say within the standard deviation range, and it's within a bullish price momentum, with the price of silver below, very close to a buy trigger, it looks like the silver market is oversold to the gold market. And I think that spread is going to narrow. So automatically you can use your protected level here on a close below 2260, and your entry point is anywhere in here close to the lowest of 2262. And you have three different choices of stops. The first is do not use a straight stop. You're going to get stopped out constantly, and you're going to be chasing the market. By the time you get there, it'll be too late. You'll get stopped out again. You'll chase another trade. You'll be chasing all the time. And ideally, one of the great aspects of the VCPMI is that it gives you a perspective view, not only in price, but in strategy, a logic, a methodology. Meaning, when the price reaches the target, it completes the pattern. You go neutral. When the signal comes back below, if it's from the sell 1 level, you're looking at a 90 from sell 1, 95% from sell 2 probability. Mathematically, the market will revert back to the mean, as you see here. You can either take either of the signals. And the target was completed, the average, and it goes back to neutral. So if you look at the range, from 23, 24, depending on your entry, as close to it, your stop would have been obviously above it. You didn't get stopped out on the signal here, and the target was completed. So it goes neutral again. And it tells me do not trade around the average because you're going to get choppy. It's choppy, even though it created now a bearish price momentum, because when the price trades around the average price, what it is the momentum of the market within that structure, within that range. The average price, the 9-day average price, is the trend momentum. So the average price is the momentum, the price momentum within the bigger trend momentum. And here it gave a bearish price momentum, and the target automatically activated is 2260. Knowing that, it came down to as low as 22. On this case, on November 30th, the low is 2265.50. It identifies pretty much the level on the average where it identifies accumulation of supply. It tells you this is the area where you want to accumulate supply. Goes back up again, testing that average, comes back down again, which is why we say do not trade around the average. You're going to get choppy. Come down again, testing it again, and finally unfolding the momentum near the entry point of 2260 with a low of 2262. So now the market is going to do what it's going to do, but this is the artificial intelligence that tells you very clearly as a self-directed trader what you do, what you want to do. So here I know basically I'm long. Again, my stop, depending upon my appetite for risk or profile, you can put a stop at a close below right away. You can get stopped out. But it's got to close below on the 15-minute bar. This is important. If it trades through it, don't get stopped out. Do not use a straight stop. It's got to be the close of the 15-minute. That's the first stop. The second is the level below. In here you have 2238, 2233. So depending upon, again, your profile for risk in money management, and depending upon how you want to position yourself, what this algorithm here is telling you, this is a great area for you if you want to do multiples, to accumulate. It could be that you started here with the first, and if it comes down here, and we'll see the energy of the market, but I'm waiting to buy into this area. Again, the AI identifies this as a strong area of accumulation of supply. this is the area where you want to accumulate supply. When I say a hard dollar stop, it basically refers to a dollar stop that you're comfortable with in holding your position against you. I personally use about $1,000 in trading silver. It's a very volatile market. Gold. And we also trade Bitcoin, which is probably the biggest contract right now in terms of the futures contract. The full-size Bitcoin is quite a sizable contract, and the margins also are pretty sizable. And we're focusing on also trading the VCPMI, applying it to Bitcoin here, and using the same principle. You can see the same logic pretty much of the algorithm, and it came up to the sell one daily level that was telling us to sell at 59,365 if I wanted to do a day trade. The high was 58,960. And it has activated now a bearish day trade. Now, you can, if you take the trade, obviously, use again the close above 59,365. And your target is 57,755. If you want to follow the methodology. The market activated a bullish price momentum, as you can see here. Traded around the average for a while. It built a nice bottom here and accelerated towards the target, and it completed the target, the first target. So here, if you had multiple positions, you can use it to lighten up, take some profits, hedge, as the second target daily is 61,290. So I'm comfortable where I am. I'm not necessarily looking to take every trade because there is a very strong underlying bullish momentum building. But it is a bit of a bought on the daily side. So it's giving you the opportunity to short-term trade the market. It could be against your long-term position. If you don't want to trade the big size contract here, MBT is the micro contract. And you can use that to trade a smaller size contract. I believe it's about a 10-to-1 leverage. I'm sorry, it's I think a 5-to-1 leverage on this small contract. And the Bitcoin market is expanding tremendously. The acceleration of growth in that sector is a historic is a historic one. We've never seen an asset that has grown at such a pace, but the volatility goes with it as well. And so you got to be prepared to deal with the volatility if you're trading the market or if you're positioning yourself. So we're going to hold on to this trade here in silver. And pretty much I have my structure in place. There's nothing to wonder or guess. The market will do what it's going to do. So this is the great thing about this algorithm, is that it does take that stress level of trying to figure out. In this case, what it is it's showing you how you can navigate the market more intelligently. Same way that you drive a car. You use a GPS, and you can get out sooner to your target. You can come back to your target. It gives you all the different options. And this indicator has a built-in process that, again, is a high probability model in the combination of using various other matrices, 4 or 5 different matrices. And it gives you this very simple, very powerful instrument. You don't need to have a busy screen with a lot of stuff, but it's again up to you personally what and how you can apply this information. I'm sharing this with you here because I believe that this will make a difference in your trading, as it did for me. And I've been around this business for quite some time. It's not a guaranteed metrics, but I've been around for a long time, so I'm the proof, basically. In this business particular, the lifespan of a trader is very, very short. So I'm very glad and honored that I've been able to be around this business in order for me to coach and teach you the way that we do it here at the Equity Management Academy. Continue to hold your position here. We got a structure. We're long. And thank you again for the opportunity, my friends, to share this with you. And I hope you have a great trading day. Be safe. And I'll talk to you soon. Thank you.